Hello guys, my name is Atosh Khan. I'm a financial consultant based here out of Mumbai, and I have been helping people like yourself and my clients to make good decisions when they're investing into different asset classes. A little background: I come from an engineering background. I moved back to India after doing my studies and working for a few years in the States, and then also to pursue my micro MBA from IIM Bangalore. And after that, I've been helping many of the people around me, uh, you know, raise awareness about uh, uh, especially finances, uh, uh, in to help them invest in the right avenues. So uh, today we are going to talk about the basics of financial markets, and I think it's a very nice topic because a lot of times we are not given the right information on what how to invest our money or what to do with our money, and that comes from an early age. And so it's important that we learn how to earn and manage our money, and that's why um, this uh, pre- presentation will take us through all of that, all of the basics. Um, so let's begin. Starting with, I wanted to define what a financial market is. So, financial markets are platforms where various financial instruments, such as stocks, bonds, currencies, and commodities, are traded between buyers and sellers. And then we'll learn a little bit about each one of these instruments in the next few slides. But the purpose of financial markets could be different for different people. It could be raising funds for a company, or it could be an investment opportunity for individuals like you and me to grow their capital. But in essence, the key function of financial markets enable companies and governments to raise funds, provide investment avenues for individuals and institutions, and determine the fair value of an asset. Moving on to the next slides, let's discuss the types of financial markets. We to start with, we all know what stock markets are. Stock markets are where shares of publicly traded companies are bought and sold, allowing investors to profit from changes in stock prices. Any big company you can think of, Tata, Adani, L&T, are all publicly traded companies. And so whenever these companies want to raise funds, they come up to a private investor like you and me, to the common man, and ask them to invest an amount into their company. And so we all, in a way, become part of the company, a part owner of the company. And so it's a beautiful concept. I think every country, most countries in the world have a form of stock exchange to kind of facilitate this buying and sharing of shares. In New York, it's New York Stock Exchange. In London, it's London Stock Exchange (LSE). In Bombay, there are two: Bombay Stock Exchange and National Stock Exchange. And so most countries have one or two, usually, stock exchanges. It facilitates a common ground where all of the buyers and sellers come together and buy and sell these this asset class. The next we would the asset class we would be talking about is bond market. A bond market is usually the most safest form of investment instrument in an economy. There can be different kinds of bond markets. So where a market where debt instruments such as government bonds and corporate bonds are traded. Investors lend money in exchange for fixed interest payments and return of the principal at maturity. So government bonds, the reason government bonds are one of the safest type of bonds is because a government cannot go bankrupt. In most, there have been cases in the past, very rarely, that governments go bankrupt. Usually they are saved or bailed out by the IMF, International Monetary Fund. And so when you're giving your money to the government and getting an interest on it, for example, government of India usually pays around 7% interest on its bonds, and so every country is different. And so when you pay this money, when you lend out this money to the government, it is more likely than not that you will get your money back. And so that's the reason government bonds are very safe. Um, one there are also corporate bonds where you lend out money to corporates, a company, and they will give you the first preference when, even if they are going bankrupt, they will give you first preference to get your money back in case of bankruptcy. So that's the reason bonds are very considered very safe. But there is also it's not zero element of risk. There is some risk, and one thing I would like to remind you, and side note, that there is no investment class where the risk is zero. There's always some risk involved, and you have to manage your own risk appetite. And so government bonds have the lowest risk involved when investing into an asset class. There are different kinds of bonds, such as us different kinds of sovereign bonds. Us issues a sovereign bond, India issues sovereign bonds. Every country usually issues a sovereign bond, which you can buy, um, either in a personal certificate kind of thing, or you can buy online. uh, Foreign exchange markets is the next asset class, and it is very simple. It's buying and trading uh, in current currencies. And so we usually see that currency values go up and down. Indian currency used to be 50 rupees per dollar, and now uh, in the last couple of decades it has risen to around, I think, 83 right now. And so currency value change, and then that's when individuals like you and me come in and buy and sell these currencies to kind of take advantage of the fluctuations in the exchange rate. The global exchange markets trades all kinds of currency, including US dollars, Indian rupees, pounds, everything. The next kind of financial markets we will discuss is commodity markets. Uh, a lot of people don't know, but raw materials or primary agricultural products can be also bought and sold in the markets. These are contracts that are made for gold, oil, wheat, coffee, anything, any commodity, and usually done in bulk. So, like 100 barrels of oil, or like so and so 1,000 kgs of wheat are bought and sold. And these are not, no one's going and buying these, like, as in, like, you'll not get your shipment if you buy these, but these are contracts are made for these. So for example, if you know that maybe in winter the coffee demand may go up, and so the prices may go up, you might bet on it. You might bet that, hey, I want to set up a contract where if it's 100 rupees per kg right now, I want to have the right to buy coffee at the same price in winter. And if the coffee price behave in a certain way as per you intended it to be, you will make a profit out of selling that contract that you signed. You can buy and sell these contracts on the market, and hence make money out of it. On the other hand, if the coffee prices don't rise up and fall down, you will lose money when selling the contract back to the market. So it all depends on how you can predict uh, the prices of commodities going up and down. And the and the last market I would discuss is derivative markets. This is one of the most well-known markets out there. We know it as options and futures. They are a little bit different to each other, but they both count as derivatives, because they are in maths. I think you might have heard of concept of derivatives when you were in high school. They're derived from something, and so um, options and futures are are based their value is based on an underlying being the stock market. So whenever uh, an options and the stock value of a company or a group of companies for that matter goes up or goes down, the options and futures value of those uh, that asset also goes up and down. um, and so they you are when investors bet on options and futures, they are betting on the in simple terms the future prices of a stock of a company. So that's how it functions. It is a huge market. Derivative markets is actually the to and fro, the back and forth of the money transfer that happens in derivative markets is actually surprisingly much more than the exchanges that happen, the monetary exchanges that happen within the stock market. So there's a lot of people betting on the stock market to go up and up, more so than they're betting on the physical companies themselves. Very interesting. It's something that people love to invest in, but they come with a really high level of risk. So you should be aware that options and futures are very risky, and have to be traded with caution. Only 95% of the trade people who trade in derivative markets, I believe, make a prof are usually losers in the game, whereas only 5% make a profit. So that's something to be aware of when trading in derivatives. Let's discuss the importance of financial markets. Capital allocation is a very important benefit, especially to companies, because whenever a company wants to be really big, they cannot depend on investors, on just investors to raise funds. You don't know how much money and effort uh, goes into buying equipments, buying factories, buying um, land to set up these factories. So every company is different, but uh, usually whenever a company wants to uh, increase its activity in its own region or a different region, a lot of money has to be raised, a lot of capital has to be raised, and uh, and this is a good way. Going public and going to the public for help, for raising money, is a very good way to raise money, because by contributions you'll get so much capital allocation that you can set up your operations. Obviously you have to give a part of your company in the public domain, but raising capital has become very easy when it comes to when it comes to making your company public. And it's not just for the companies, it also creates wealth in the economy. Whenever a company raises funds and increases its operations, there are jobs that are created, so they pay out the employees save money, and there's this entire cycle of stimulating the economy and kind of creating progress for everyone. So wealth creation is the second importance of any financial markets. And the third I would discuss would be price transparency. Whenever a company goes public, it has to share all of its records, all of its financial documentation with not just the government, but also people who are investing with the company, and people to the public essentially. So there is less likelihood that shady business is taking place behind the scenes, because whenever we know that whenever companies operating behind closed doors or closed curtains, it becomes there's always room for these things happening behind the scenes, this shady business happening behind the scenes. And open markets kind of facilitated transparency within the market, that is good for the economy. I think we should have more transparency within government, but that's another topic to discuss. Uh, let's move on to the benefits of financial markets. To you as an individual, there's potential for growth. Whenever you are investing in a company, you are part owner, as I already mentioned, of the company, and it gives you a chance to grow your wealth. Maybe if you're in a job, your salary might grow on an average by 4% a year or 2% a year, but when you're investing in a company, it might grow much more than that. It might go up to 20% per year, and you might see your savings grow as well. It gives you an opportunity to diversify your investments. You investing in in a different asset class gives you opportunity that you can spread out your savings, spread out your capital, not just keep it as cash, because cash might depreciate, sorry. We have seen Indian rupee go down, the value of Indian rupee go down over time. So even keeping cash in your bank account might be bad for you, because you are losing money to depreciating assets, and you're losing money to maybe inflation is going up, things are getting more expensive, so value of money kind of reduces over time. But investing in something like stocks or bonds might help you grow your money in certain ways. The third reason I would say is liquidity. If you're investing in real estate, you might have to wait for a few. I mean, you might have to wait a certain time to kind of buy and sell your land, and that kind of give you less control over your money. Whereas when you're investing in the financial markets, it is instant. You can buy and sell stocks, or even bonds. You can buy bond contracts and sell them in the market, and someone else would buy your bond contract. So these things are nice to maintain a sense of security. If things go bad, you can just encash the your investments really fast, within a day, within minutes, in fact, and get your money back when you need it. And the last benefit to you would be access to global markets. And now, one thing I would like to say is, sometimes we are very biased when it comes to investing in a certain industry, or in a certain market, even in a certain country, uh, because we know more about a certain area of investment. But it is important to know your biases, because there might be a chance that a country like Nigeria, a country like Bhutan might grow faster than India. And investing in financial markets give you the opportunity to invest in those countries as well. And now, if a lot of you don't know, you can invest not just in Indian stocks. You can also invest certain applications that you invest in the US market, or in certain other countries. And so that kind of gives you gives you an opportunity to diversify your investments into areas where you might previously not have thought of. um, Mm, so my last few advice would be to anyone who's starting off investing their money. Most of you are very young, I believe, and I think one thing you should always do before investing your money is research and educate yourself. A lot of us don't get the financial education early on in our lives, and that's why we have to read, we have to take up courses, we have to listen to financial professionals, um, and take up courses, take up online, look up online resources where we can increase our knowledge of how we can better earn and deal with our money, better invest our money, because that's a very important thing, a very important skill for anyone to have. Uh, Secondly, I would say your second step would be to develop a plan. because without a plan you won't get anywhere. In order to get to your goals, you have to understand where you have to be. You have to understand what your financial goals are, what are your risk tolerances, what are your timelines. These are some of the things I help people. I help guide people with when they come to me to improve their financial portfolio. And the third thing I would say is to start small. Whenever it's not like you will uh, automatically start earning a lot of money and start saving. You have to start somewhere and start early, start small. So even if you're in your early 20s and you're earning, I don't know, 1,000 rupees a month or 2,000 rupees a month, try to make it a point to save at least 10% or 20% of your income into some kind of investment instrument, and try to start that habit, because that this habit is like very slowly built, and yeah, it can't be done all at once. It has to be done slowly, and eventually, when you're in the 30s and your 40s, you'll see the benefits. You'll see when the money starts coming back to you. You'll feel really proud of yourself that you started early. In cl- so, in conclusion, I would like to end my presentation with the learning that this is a great opportunity for every one of us to start investing, especially in our country, in India, where I'm from. The economy is growing really fast, and companies are growing really fast. Apart from that, there are other investment avenues that are growing really fast. So take up this as a learning and as an opportunity to uh, to grow as a person, grow as an investor, grow your finances uh, by learning in the right way and diversifying your investments the right way. Thank you.